Welcome back. This week, we're going to talk about the meeting that happened with the FOMC and its impact on the market and interest rates, where things are headed. It was very positive for interest rates in the future, and it was positive for the equity markets. We'll go into put sales, where this week we did 11.18% return on puts that we sold. We'll get into some other trades where we talk about volatility crush, and I'm going to introduce you to a new indicator that I have written. Then we'll get into the market outlook. But before I do, I want to ask you a couple of questions. I've been doing this for about 3 months, and I would like to get your feedback. Keep doing what I'm doing, find topics that I find interesting, and keep doing the market outlook the way it is. I try to keep my videos to about 20 or 30 minutes. I'd like to know your feedback on that. B, more training videos. Maybe you want to know how beta works, or MACD, or RSI, or Bollinger Bands, or any of those other indicators, or maybe you want to know other derivative strategies out there. I can do that as well. Would you like me to keep my videos more singular focused, maybe 1 or 2 topics versus several topics in one? I could still do all topics, but I could spread it out throughout the week and break them up into maybe 10-minute chunks. I try to do it all together because the topics I do are heavy and they take some time to absorb, and that's why I've been doing it the way I've been doing it. And then that way you can see where my thesis is and where things are headed, and hopefully things will make sense. But if it would be more digestible in 10-minute videos, singular topics, I can do that. So let me know your feedback on that. Would you like to know about other indicators and things that I look at? Maybe even follow my trades. Would you like to subscribe to my trades? I've been showing you my put sales because I know that works. I love that strategy. I've been showing you a couple other ones from time to time, but I will place several other trades based on what I see maybe throughout the week or other indicators that I use. So if you'd like to see that and potentially subscribe to following my trade, let me know. Be glad to do that. Or is there a topic I haven't even thought of yet that you would like to see? Now, none of this is a singular thing like just do A or just do C or D or whatever. If you'd like to see both, maybe 2 or 3 of these, let me know. I'd love to get your feedback. I've got my loyal listeners that I know watch every week. And if there's something you'd like to see, please let me know. Help me shape this. Would love to have your feedback to help me build it to what you want to see. I love this stuff. I've been doing this since I was a kid. Been investing since I was 20. So that's 30 plus years of knowledge and experience. So that said, let's jump into it. As always, this is not financial advice. So this week, put sales. This is what we talked about last week of what I was going to enter. All the scribbles on the side with the purple and the green, those are the companies that I entered. And we did 11.18%. Now, before I go into this, I want to make sure that you guys aren't thinking that I'm bragging. I tell you every week, hey, we did 5.7 or 7.8 or 10%, 14%, whatever. I'm not bragging. It's the truth. I wouldn't put my face out here on YouTube if I didn't believe in this stuff. I've been doing this for a long time, and it works if you know how to do it. I have created training videos on how to do this. So if you want to check that out, look under Option Strategy Explained, and it's under Selling Puts During Earnings Season. There's some videos on exactly how I do this. But again, I don't want you to think this as I'm bragging. This is mainly because I want to show you how it works. And I'm doing this for my kids. One day, they'll be interested in trading, and I want them to have a reliable source to come to. So I'm putting all these videos on YouTube for my kids and you guys. But this stuff actually works. So when I say 11.18, I'm not blowing smoke. It's the real deal. And there are times that I lose, and I'm trying to be honest and let you know when I do lose, but I can work my way out of it with derivatives. And that's what I want to show you is this, it does work. All right, so enough of that. Let's get into it. Uber, take a look at that. $200 spread. None of these spreads this week were over $250. Every spread was $250 or less. And because volatility is in the market, we did really, really well. So Uber was $14 for a $200 spread. Again, I'm only doing this as one contract to show you this can be done in small accounts. I'll do more than one contract. Maybe sometimes I just do one, but sometimes I'll enter more contracts. It's up to you. But I'm showing you that if you just picked one position on each one of these, you'd use $1,600, made $179. And that's an 11.18% return. So all of these were 100% successful. So it's a $200 spread. Look at this $200 spread on Spotify. $35 on a $200 spread. So imagine if you did 10 of these, $2,000 is what you set up for your risk, but you would have made $350. Where else are you going to put $2,000 to work and make $350 in 1 week? That's a pretty good deal. $250 spread on this one, $26, a little over 10%. $200 spread, $18. You get the idea. All of that added up comes out to 11.18% return for the week. Not bad at all. Earnings season is coming to a close. We'll get into what we're going to do for next week at the end of this video. But I'm going to be sad because I do love earnings season for this reason. All right, I'm going to introduce you to a new indicator that I have written that highlights when it might be a good time to sell a vertical spread or buy a put or sell a vertical call spread or buy call options. And essentially what it does is it goes out and finds the standard deviations, and it finds that if it goes above 4 standard deviations and then retraces back to the 3rd standard deviation, there's a sell signal, or vice versa. I'll explain it in another video, but for today, because I want to keep this market brief a little bit short, look at this. I had a confirmed sell signal. We're in a downtrend. This is our 200-day moving average. This is our 50-day moving average. Both of these were in a downtrend. So we have downward momentum on target. This is for the entire year. And so here I bought a put, waited for it to go down, and then I sold a put. The put was for, I think it was a $95 puts, somewhere along in here. Or, no, sorry, $96 puts. That's where I entered. And when it went down to about 91, then I turned around and sold a $91 put to help pay for what I paid for that. So that if the market retraces and target goes back, I'm not really out anything because I've already paid for it with this sold put. I'll get into that in other videos, but this has been profitable. This was a good one. Here's one, the Cooper companies that did the same thing on this one. Let me switch this to year to date. Got a confirmed sell signal on this one. I bought puts and waited for it to go down. And this one, I did not sell a put to pay for it. I just got out of it. Once I took my profit, which was, I think this was close to a 50% profit on these puts, I went ahead and closed it out and took it and ran. But you can see this signal seems to be pretty reliable. So far, I've tested it for a while. There's my confirm sell, my confirm buy, confirm sell, or confirm buy, a sell. Now, not all of them work. Take a look at target. Here's a confirmed buy. Now on this one, because it was already in a downtrend, I would not have bought a call option. I would have sold a vertical spread, and I would have sold the vertical spread somewhere down in here, and I'd have probably only done it for about a week. So I would have been profitable on this one. Same thing with this one. I would have been profitable. I wouldn't make much. I would make the equivalent of what I'm making on the put sales. So this strategy works. I wouldn't buy calls here. So there's a little bit of intuition, a little bit of knowledge that has to go into this to say when would be a time to buy a call or when would be the time to sell a vertical put spread. That's up to you. I'm going to go into another training video on how I do it. If you guys want to see it, let me know. Throw me some notes in the comments. Those are those two. Let's go into earnings. We did Volatility Crush, and I'm going to show you one that didn't work out so well. We did 4 of them. Western Digital, that was profitable. Starbucks, that was very profitable. Starbucks, I'll go into that one in here in a second. And that was very profitable, but volatility collapsed and I took all the profit. It was like 100% profitable the very next day. But eBay and Chipotle, not so much. Hindsight being 2020, I should not have went into eBay, but I got a little excited and thought, let's go ahead and play it. Volatility was super expensive. The implied volatility was like 160%. And I thought, man, they're super juicy, so why not sell some premium? And this was my break even. I had it where after earnings, as long as it stayed below this and above this, I was going to be profitable and I would have done a decent job. But instead, opened up 15% lower and then kept going down. Here's the thing though. While if you would have done one contract, you would be down at this point from $100 down to 81, you'd be down almost $2,000 because you're going to do this in 100 share increments. So you'd have been down $2,000 for that $20 move. I'm only down $300. And that is because what I did is I bought a put in the long end. So I sold front month volatility, which meant, and again, I'll get into the nuances and details in another video. It's too long for this one. But I sold the straddle in the front month where I collected a ton of premium. $9 actually of premium, so $900 worth of premium. But then I bought a back month put at $93 so that if it goes down, then that put's profitable. So I do have a very profitable puts, but the front month, so now I'm only negative from here to here, but only not even really all of this play, because this put is now protected this guy. So next week, I don't care. I don't care if this falls even further because I'm 100% protected. The most I'm going to lose is that $200 or $300. But I will end up working my way out of that one. Let me show you Chipotle. Did the same thing on Chipotle. Man, this used to be a Wall Street darling. Look back in July, we're like $50 to $60. And then look at this earnings here. I did the same thing, sold my volatility up front. And this is my initial break even. But I bought puts on the back month. And that, at this point, per contract, again, this fell 20%. So it was $40. It's now down to $31. That would have been $900 for a $100 play, a 100 share play, or one contract play. $900. You know how much I'm down? 90. And that's because I bought this back month put. I'll work my way out of it. I don't care next week if it drops another 10%. It doesn't matter. Another 15%, it doesn't matter, because the most I'm going to lose is 90 because I've got this put protecting me all the way down. And then what I'll do is when next Friday that put expires, if it doesn't come back up and it comes back in this range, if it comes back in this range, guess what? I get to keep all that volatility that I lost this week. I get to keep it back because I still got the position, and I'll work it back if it goes back into this range. I don't know that it will, probably won't. But if it does, hey, I'm super rich or lucky. But if it keeps going down, that's okay too, because then next Friday, when that put expires, I'll take all my put profit. My cost basis is still $90 in the hole, but I'll buy another put at, let's say it drops to 25. I'll buy a put at 25. That might cost me $2. Then I'll turn around and I'll sell a call above this price at $25. I'll put it at 26 or maybe 27. That 26, if this one's selling for 2, the 26 is probably going to be selling for 2 or maybe $1.90. The 27 might be selling for $1.50. That means my insurance, to pay for that insurance, cost me $50. So now if you add it all up, I'm going to be out 90 and originally 50. That will cause me to be out $140 if it keeps on tanking, but it probably wouldn't. And because this is going to be for a month out, then I would then wait for that to go up $1 or $2. All it needs to do is go up $1 or $2, and I'll make that what I lost, the 90, plus I'll pay for the insurance. So I'll make $60 on that. I will work my way out of it. I'll either break even or I'll work my way out of it. One of the two. I know that was a lot of detail. Probably didn't make a whole lot of sense. That's fine. I'll create another video. Send me some comments if you want to see that video. That's how I'm going to work out of it. So I'm not worried. I'm not worried because I use derivatives to protect my position. It's all good. Let's take a look at Starbucks. This is when it works out. Look at Starbucks. So earnings was right here. It opened here and closed here. Guess what? I took all of that. That was 100% return because what I paid for it, I doubled it the very next day. And then I got out of it. Why keep it? These earnings crush plays are very short term. All right, let's go into the market. So from the market perspective, a volatile week, we were down, or actually we're up for the week, 0.71%, but we did have some decent moves. So volatility is still in the market. Earnings for the week, when you look at all the earnings, you got $294 of earnings, which is a PE ratio of 23.2, which is high. So it wouldn't surprise me to see a little bit of pullback. However, there's some other things that have happened that are going to be supportive of prices. We are very close. We're within 2% of the 7,000 mark. I can almost guarantee you we're going to hit 7,000 on the S&P. Just clearly from the momentum, people are starting to think, yeah, we're definitely going to hit 7. 7's going to be an interesting number to watch because it's a psychological point. People are going to want it to go there, and then people are like, all right, is this the point I'm going to sell off and it's going to pull back? Who knows? But we're coming into a good time of year, plus some things that the Fed said that I'll get into here in a second that will be supportive of prices. What's not supportive of prices are layoffs. Take a look at UPS and Amazon. They had some significant layoffs that they announced in October. That's not good. And then we still are flying blind. We don't know where the government layoffs, how many of those people that were laid off back in the first part of the year, their severance runs out in September. So that means they're going to start reporting how many of those people haven't found jobs yet. Those were going to start reporting here in October, November timeframe, and we're flying blind. We don't know what that number looks like. So that is not supportive of prices. So definitely be cautious, hedge yourself. If the market goes up, set your stop losses higher or buy puts on the market to protect your profits, or you can buy call options on VIX, and that's another way to hedge. So look at for the week, we have S&P 0.71, IWM is down 1.28%. IWM is small caps. That's the one I've been talking about. I'm going to be long. I'm actually raising. You've heard me talk about 235 as my entry point. My entry point now is 240. So I'm now selling puts at 240 and waiting for it to come down to me. I will collect the premium in the meantime. And if I get exercised, well, I get all that premium and then I'll pick it up at a discount from where it is today. TLT down 1.29% for the week. That's because of what the Fed said. We'll get into this in a second. XHB is 3.48%. We're down to 105. Now I'm going to be selling puts on XHB. That's the housing market because it fell because interest rates rose. Interest rates won't be here for long. Utilities, sorry about this. I don't know why it is not giving me very much room there. Utilities came down 2.51%. Data center went up another 0.36. I'm waiting for data centers to pull back to about 2150, and then I'm going to be entering that. AG&C fell because of rates. I started selling puts again. And then live cattle. Man, what a week on cattle. Take a look at cattle. Got this confirmed sell signal. This is the same indicator I was telling you about a minute ago. I got a confirmed sell. I did sell, but unfortunately, I got out of it right here. And then if I'd have just kept it a couple more days, what I made, had I kept it to this point, and you can never do this, so I'm just telling you because it's like, it's sick to your stomach. You're like, man, if I would have just held it for 2 more days. You always say, don't get greedy, because the minute you get greedy and you hold on to it longer thinking, oh, it's going to go down even more or it's going to go up higher, it pulls back on you and then you're out. So don't ever get greedy. But sometimes you go back and go, man, what if I would have held out? I would have been up 10 times if I would have just held out to right here. Instead, I bought the puts and I made 75%. So for example, I bought a $1,200 put, made $800. I'm just using one contract. And if I'd have kept it to here, it would have been $8,000. $8,000 on a $1,200 investment per put. So yeah, I'm kicking myself that I didn't hold out a little bit longer. But that's the way it goes. But still, hey, I made 75% on the puts that I did buy. So it was still a good play. All right, what's coming up this week? We've got PMIs. This is manufacturing. Don't expect a whole lot of movement here. We're supposed to get JOLTS, which is your job openings, losses, and quits. And then this Friday, we were supposed to get unemployment. This will be the second month unless the government opens up. We'll get consumer sentiment, which will be good. It'll be interesting to see that. That's on Friday. A couple of PMIs, and that's it. We are flying blind. All right, so Jerome Powell, the FOMC meeting this week, we did cut rates another quarter, but is what he said at the presser that made all the difference. So he did indicate if you're driving in the fog, you slow down. So he very clearly said that there is no guarantee of a rate cut in December. I still think there is, but I understand where he's coming from. He's got to play it safe. You don't want to make any predictions when you're flying blind. And so slow down, hold up, and don't make any rash decision. So that's what he's doing. That caused TLT to fall because that's representative of 20-year bonds. All rates rose because of that statement. But it was what he said about quantitative easing or quantitative tightening that made all the difference and will make all the difference in a month. So QT is coming to an end on December 1st. What that is, they've been doing their balance sheet runoff. And as you can see right here, this is the runoff that they've been having on their mortgage-backed securities, their treasuries, and so on and so forth. We've talked about this before, where once they get close to ample reserve, this is all the money in the banking system. Once they get to this point, they will call it and they'll stop quantitative tightening. And that's what they're doing December 1st. This is getting down to 2.9 trillion. We talked about the 2 to 2.5 trillion mark is that ample reserves. Look what happened that's causing them to drive it. I mentioned this a couple of weeks ago that I thought it was going to be within the next 2 or 3 months. They're ending it in the next 30 days. This right here is the effective Fed funds rate. Think of your overnight rate. Okay, so every one of these are your cuts. And look how flat this line is. This is what's causing the problem right here. See that rise? Over the last month, this is supposed to be 4.08. It went up 4 basis points, which is not a danger sign, but it was definitely a warning sign because that meant liquidity is drying up in the banking system. There are banks and other funds that are going into the repo market, and that signified to the Fed that liquidity is drying up. What that means is now they're going to stop quantitative tightening. It's not the same as quantitative easing, but it's going to take the foot off the brake. So before, they were taking mortgage-backed securities and they were allowing them to mature, and then they were just holding the cash. Now what they said they're going to do is they're going to take the mortgage-backed security maturities, and instead of putting it in cash in their side, they're going to take that cash and reinvest it back into treasuries. This is going to be very supportive of equities because it's supportive of bond prices. What they're going to do, though, is they're going to buy treasuries on the short end of the curve. He specifically said T-bills, which is like your 3, 6, and 1 year treasuries. So that is going to keep the front end of the curve down. You can almost think of now interest rates will not go any higher because now you have a buyer back in the market, a big buyer. You didn't have the Fed buying treasuries in the past. They're a huge buyer of treasuries a long time ago when they're doing quantitative easing. When they were doing quantitative tightening, they were not buying treasuries. Now they're going to be buying treasuries again. They're not buying the long end of the curve, think mortgage rates. So those will probably stay about where they're at. But what will happen is the curve will steepen because they're still lowering rates and they're buying a ton of treasuries on that short end of the curve. So that will keep those prices down. The long end of the curve will come down over time, but it will actually steepen. So as this front end comes down, the long end stays where it's at. That'll be the steepening of the yield curve. If there's any kind of recession or unemployment goes up, then you can expect the long end of the curve to come down because you'll have to spur economic growth. The long end of the curve, everybody will go to flight to safety, be buying treasuries like crazy because the rates will be 4%, the market will be tanking, and that's where unemployment. So that it's in one way, if unemployment stays at bay and works like it's supposed to and doesn't go up a lot very quickly and just cools, that'll be okay. That will keep rates the same. But if unemployment craters, the market's going to fall and everybody's going to rush to bonds, and that will cause bond yields to fall and mortgage rates to eventually fall. I don't know when that's going to happen. I do think it will happen. I do think a recession is coming because of weakening unemployment. And then you're going to have potential inflation issues. I do believe the inflation job's done, but it's going to be interesting because if you drop rates, that could cause inflation to come back. We'll see how it plays out. But that's my thesis. So I think in the short term, definitely supportive of market prices with interest rates, but watch unemployment. That will be everything. It's not inflation anymore. Let's take a look at the interest rate probabilities of where the terminal rate is going to be for the end of the year. Right now, because of what the Fed said on Wednesday, the market pulled back. There's only a 63% chance of a rate cut. There was it was definitely over 90% before he spoke, but he said he called it off the table. He's like, hey, there's no guarantee. We're in the fog. Let's slow down. Don't just count on a rate cut. That's why prices fell on the equity side initially. All right, but here's what I think. If you go down, you've only got one cut here, and then you've got 2 cuts for all of next year. I don't buy that. I don't buy that one bit. We know we have weakening unemployment. And you've got 4 dissenters. There's a pretty big disparity of views within the governors and the voting participants. One guy wanted more. Myron, you already know who that is. He wanted more cuts. One person didn't want any cuts. You have opposing views, but you've got 4 people that are on the side of Trump that are aligned with Trump. And then, don't forget, Powell leaves right here. So he leaves in May. Who do you think Trump's going to put in there? It's going to be somebody who's aligned with him and will want rates to fall and to help spur economic growth. Who knows what's going to happen with unemployment? That could change everything in between now and then. But even if unemployment's still solid, you're going to get somebody in there that's very supportive of rates falling. That means the terminal rate here is overpriced. Right now, the ZQZ future, if you want to go out and buy it, I'm going to go out and buy it, is priced at a rate of 3.08 as the overnight rate. Next year, that's only 2 cuts. And we got one more cut probably in December, and then we got 2 cuts for next year. with Powell leaving and the other arguments that I've made, you can expect this to probably shift this direction. And I would think that your rate is going to be somewhere in this range. So if you bought a ZQZ, one contract, 1 basis point move is $41.67 or $800 per, roughly $800 per 25 basis point move. You've got 50 basis point move, what I believe, at a minimum. $1,600 on a $2,000 investment, because that's what it takes to hold a futures contract for ZQZ. So that might be an opportunity if you want to just sit and hold it long. I will probably do that. I may even buy some more 2-year treasuries to take advantage of this move. All right, enough about that. Let's jump into put sales. Put earnings are winding down. This is what's coming up for the week. These are the number of companies that are reporting each day. My scanner went out and chose companies that had high implied volatility and would be good candidates. So I'm going to stick with mine because it's been 100% successful so far. So with that, here are the companies that are reporting. I will probably open up a position on Barrick, Applied Materials, Alibaba. I've done this one before. And CRM and Micron. Look at Micron. Definitely some juicy premium right here. These are the strikes it's recommending. Again, I'll go out Monday morning. If you want to know more how I'm doing this, check out Option Strategy Explained on my channel. And there's a video on how to sell puts during earnings season. So this is what I'll be playing, and then I'll report back next week. Finally, you hear a lot of talk on the talk shows out there about money market funds and how there's a lot of money sitting on the sidelines and this will be supportive of equity prices. I completely disagree. And here's why. You've got $7.5 trillion sitting on the sidelines that these guys out there everybody kind of repeats everybody else. I work for a bank, and I'm not going to give you any specifics about my bank, but banks in general cannot put their money, their equity, into the market. Financial services companies are not allowed to do that. You also have life insurance companies and pension funds. Those type of companies have restrictions on being able to put what kind of money in what different types of asset classes. So as a bank, and you have a whole lot of banks out there, there's about 10,000 banks across the United States, they're not allowed to put their money to work in the equity market. It is too risky. So they're allowed to buy money markets and they're allowed to buy bonds. They cannot put it in equities. So banks, life insurance companies, then other companies. There are other companies out there that have their retained earnings and will be safe. Think of the Amazons, eBays, any company out there. Do you think a lot of those companies are going to take their savings accounts, because that's all this is, are savings accounts for people? Do you think they're going to put their savings accounts and risk? Some companies, sure, but not all of them. But I'm talking about financial services companies. They're not allowed to. And there's a lot of money that's tied up in this from banks and financial services companies. Secondly, the other portion of that money that is made up of individuals, and this is what I think the talk show hosts and stuff get wrong, is this is not all individuals, but let's say a portion of it is individuals. Let's say half that 7.4. And there is a number out there, and I saw it, and it's roughly around half. Of that half, so you got $3.5 trillion that's left. Of that half, a lot of it is made up of the boomer generation and the senior generation. Do you think that they're going to take their money when rates fall and they're going to put their money to work on the money into the equities? No. Boomers, some boomers will, but a lot of that money is not going to come out of money markets, because boomers, the older generation, is going to keep it in certificates. They're going to keep it in money markets. Even though rates will fall, they're locking it up right now in longer term certificates, or they're going to put it in certain other type of funds that's going to guarantee them a return. They're not going to stick it in the market. So it is an incorrect statement to say that $7.5 trillion are sitting on the sideline. It drives me nuts every time I hear these guys on these talk shows say that money's sitting on the sidelines. It's not. There is no money sitting on the sidelines. There's some, but not a material impact. What's going to be supportive of bond prices is what the Fed is doing and interest rates. Watch interest rates. That's going to be good. AI still, that boom is still going. Is it a bubble? I don't know. That's going to be supportive. for a while. But then the other side to that is watch unemployment. That's going to be everything. Whatever you do, play it safe out there and hedge your bets. Move your stop prices up and buy puts or dollar cost average, and don't worry about it. Just buy and hold. With that, thank you so much. Again, let me know. Go back to the first part of the video, look at your A, B, C, D, put some notes in the comments. Let me know what you're thinking. And I want to tailor this to you. I love this stuff. I do it for free, and it takes me about 6 or 8 hours to do it per video. And I want to know that I'm doing stuff that you like. With that, happy trading. Have a good one.